Welcome to today's meeting of the Audit Risk Committee. By the way, I welcome retailer to the team and our Staffordshire. Okay. First of all, everyone had a chance to read minutes and
Yes, Chairman, we've got apologies from Councillor Barry Bond.
thank you. Have any declarations of interest? In that case, move on to our first report, external audit and external. Take us through.
Thank you so much for I'll be the audit and that's so I've got a couple of years experience audit mainly I'll just draw you to the key aspects of and to this shows you the we basically that any that we are doing report. So I will touch on the headline materiality. So in terms of significant risk area and risk of materiality statements, these are obviously one. We have management. This one is by the eyes, and we have any discretion to actually revise. And in terms of the work journals, rural segregation of peers, then our next significant risk of materiality statement and expenditure recognition is also national standards and audits. However, we do have discretion to case, but did to opportunity available for expenditure. Then we also have PP planted equipment, which we consider and this classified measurements and nature of myself. We might actually engage our own experts, probably out of range with testing. Then last bit on the risk of materiality statement, evaluation of mention and net liability of us and risk due to the subjective So we've not identified and just in on one. So we are also required to place and with the three categories which are financial and governance, how the body properly managed, and the last bit is efficiency and basically how the body about to improve and that is. So we have performed our initial planning and risk effectiveness. However, during going to take that again, we'll place to transformation to support. So inform then in terms of page 18. So the audit team consists of audit partner. I changed to have the previous ones finding based decided to post it. Then in terms of audit logistics, so we already started doing our plan. Then to start our so then we intend to complete provided that and the any findings that testing was then as part of our onboarding prior to then if I can just page 20. Based on the work I expect to take, this will also in terms of have the house house perform some assurance. Then in terms of other things, could like that but also okay, moving on to materiality. So we have set the headline materiality total areas exceed value. Appendix 1. Then we've got the performance which we use testing at 60. And the trivial threshold is touched on earlier. Partiality.
Thank you very much for that, Sarah. I'd like you to take you back to a general comment. Danger of that. Thanks for the question.
Okay, so so far we haven't identified anything at risk. So we just do this. So large chances that okay, so in terms of the deficit, is it possible for me to take that question probably address it in
Yes, it was just general.
Yeah.
Maybe you'd answered it. General. I will my other question coming from the
outcomes to be confirmed. At what point will that be confirmed?
Sorry, can you come again?
It's around that question around the additional work arising from audit outcomes. It's to be confirmed. Please, at what point those audits be confirmed within that?
Okay, so once we've completed the audit work, we'll be able to give you. Hopefully, we're expecting any challenges, management in terms of getting the done or any. So I'm not. I can't promise you that there won't be any overrun. We're going to minimize a significant variation.
Questions?
It's another question. Margaret, welcome to Codsall and South Staffs District Council. Very good working relationship with previous auditors. I'm sure the relationship, 30 days that you've seen, they've audited quite well. Too many stones unturned. I'm sure that the relationship with teams will be support you.
Thanks, Chair. Just a quick question. It says on the got to finish with previous years or commence. How far are we to audit?
That's out of our hands. Our accounts have been Staffordshire pensions to
Thank you, Chairman. A very good question, Councillor Evans. The last indication when I spoke to Grant Thornton was the end of February, so we're looking weeks away. We're very much hoping for that final tick in the box. What members will recall from the previous meeting, Audit Risk Committee, is that you've delegated authority to Councillor Michelle to simply sign the document. The pray there is appropriate, assuming there's no alterations required from the statements that we get from the pensions fund, but we're very much hoping it will be as soon as it's been indicated for Grant Thornton, end of February, next 2 or 3 weeks, the delegated authority will kick in, the accounts will be signed off, and Martha will be just as delighted to know that that final obstacle is cleared and they can start from a clean sheet. So apologies for interrupting, Councillor. That's the latest situation.
Councillor Duffy, question.
Thank you, Chair, and thank you, John. Does that mean then on the timescale that the interim audit will start in March rather than February?
Can I ask Martha to answer that one?
All right, so we intend to start the interim audit this February, so it might run through to March, depending on how we get our responses back from the management. But hopefully just between February and March, but we're starting next week.
Thank you. We have an audit meeting on the 2nd of April. Hopefully we have it by then. If things go to plan as we say, yeah. If not, come on, thank you very much for coming, introducing yourself. And I think the recommendation is that we note the report. All happy with that? That brings us to item 5, page 22 in your reports. And this is the quarter 3 internal audit progress report, brought to you by our Chief Internal Auditor.
Thank you, Chair. So this is the regular progress report highlighting to members internal audit work carried out since the last progress report back in October 2023. So my report starts on page 24 of your pack today. So turning to page 24 of your pack, you will see that 32% of the audit plan has so far been completed, with a further 53% of the plan currently underway. The rest of the work will be completed by the end of the financial year. So towards the bottom of page 24, you will see that there's been two audit pieces of work that have been finalised since October relating to grant verification, the Disability Facilities Grant, and also cybersecurity. Both of those have been given positive assurance opinions. We've also got a further 3 pieces of audit work that are currently at draft report stage. One relating to the digital transformation and in particular the customer experience improvement programme, which was looking at project governance, looking at the website itself and use of the online forms. Also, we looked at treasury management, which is quite up to date because there's a number of treasury management reports that are on this agenda. Again, that was looking at the governance arrangements, the strategy, monitoring and reporting, reconciliations, and the management of cash flow. Then the third piece of work was in relation to IT asset management and user devices, which was looking at the control and management of devices and access as well to those machines. In addition to our systems audit work, we also conduct various counter-fraud activities. In particular, we look at using data that's at our fingertips here at the council, and we undertake a range of continuous compliance monitoring, which looks at this moment in time, creditor payments and purchasing cards. And again, we use that data to highlight any possible anomalies, and then we'll investigate those. So far, there's nothing to report of any concern in relation to both of those areas. In addition to our CCM work, we also undertake and coordinate the National Fraud Initiative. That is a biennial exercise, mandatory for all local authorities, and that's where we submit various data sets, including payroll, creditors, council tax, housing benefits, and pensions data. And again, it matches against other public sector organisations to highlight any potential irregularities. That data comes back to the council in secure form using a database, and the various services across the council investigate and put their results back onto the database. Finally, on page 25 at paragraph 3.8, I just wanted to give you one further update in relation to the irregularity that was presented to the committee back in November. So if you remember, there was some cash thefts at a leisure centre. The police are still investigating the cash thefts. The council did instigate its own internal disciplinary proceedings against an individual, and in between the disciplinary starting and finishing, that individual resigned from their post. So from the council's point of view, that matter is closed. However, there is still the police criminal investigation that's ongoing at the moment. And once we get the outcome of that, again, we will report that to this committee once that's gone through to completion. Chair, I'm happy to take any queries. If not, if members could just note the report. Thank you.
Thank you very much for that. Anybody on the floor with any questions? No, nothing. It's quite straightforward and something on target. As Debbie says, the recommendation is to note that report. We're all happy to do so. Thank you. Now move on to item 6, risk management update, pages 27 on your pack. And this is a report of the Director of Finance and Section 151 Officer. Beth, can you take us through?
Thank you, Chairman. Yeah, this report starts on page 27 of your packs and provides an update on the strategic risk register for the council as at the end of Q2, so September 2023. And the council's strategic risk register can be found at Appendix 1 at page 29 of your packs. As you can see, the majority of risks are rated amber and are being actively managed so that the scores can be reduced or at least maintained at the same level. The only risk that has increased its score between quarter 1 and quarter 2 is the one relating to the local plan. And this had increased from 12 to 16, but was due to a continued absence of the NPPF. This has now been published by the government just before Christmas, and so we are expecting that at the next update at quarter 3, that risk will have reduced. In terms of red risks, the only red risk that we have at quarter 2 relates to the delivery of the waste contract. Again, this was largely due to the lack of government guidance at that time on simpler recycling reforms. Again, we have now received that guidance, so we also expect this risk to reduce at quarter 3 too. And lastly, just to let Audit Committee know, we are in the process of reviewing the Council's risk register and risk management processes at the moment. And we are hoping to have completed that at the end of March, so so that we have a revised risk register and risk processes that are aligned to the new council plan and the new integrated performance management for the council. And that concludes my summary. Happy to take any questions, Chairman.
Thank you very much. Anybody with any questions? No, in that case, the recommendation is that we recommend for adoption by the council each of the 5 elements of this report. Do we all recommend? Is it? No. To review and accept this report. Thank you. And now to item 7, Treasury Management Strategy and Prudential Indicators, 2024-25 to 28-29. This report by the, actually, this report is going to be presented by John Mayhew. John, yes, thank you.
Thank you, Chair. And the first of 3 reports I'm going to present, so you'll be bored of me quite quickly, I suspect. The Treasury strategy we're presenting this evening is an annual report taken to eventually full council, and just a very technical report, which I'll try and present as best I can in layman's terms. But one thing in context for members hopefully to appreciate is that none of the strategies that we present to council should ever be viewed as standalone documents in their own right. Each of our strategies informs and is informed by the other strategies that we present. And in terms of Treasury strategy, in particular, the medium-term financial strategy, and perhaps even more so, the capital strategy. We've done quite well this year in, I think, bringing them all together, such all 3 reports, I think, are scheduled to be presented to full council on the 20th of February. So hopefully members will be able to get a greater view of how they all knit together. The role this evening of the Audit Risk Committee is to, if in agreement to the recommendations, in due course to effectively recommend to full council that the Treasury strategy should be adopted, of which there are 5 areas for approval to recommend. If I can refer members to page 50 of your packs, the indicators are referred to amongst recommendations, makes particular reference to one called the capital financing requirement. The capital financing requirement measures, they're a vital component of an authority's capital strategy. Effectively, they're the amount of capital spending, much of which will be historic, that has not yet been financed by capital receipts, capital grant, or a contribution from revenue income. What it therefore in fact measures is the underlying need to borrow for a capital purpose, although that borrowing, whilst it uses the phrase borrowing often makes people think in terms of borrowing from banks and externally, it does not have to necessarily be external, and much of our borrowing takes place from internal resources. Within that, there's an important component called the minimum revenue provision. And this allows me to refer back to a very good question I think Councillor Evans asked at the last meeting of the Audit and Risk Committee around, given the borrowing we have undertaken for recent capital expenditure, including this building, the question put to me was how could we be sure we've got money set aside to repay that borrowing when it comes due? The minimum revenue provision that you see written down is a mechanism by which we ensure that occurs. And when the time comes to repay borrowing, the resources are there to do so. And the minimum revenue provision itself also, if there wasn't a capital spend take place, would periodically reduce the capital financing requirement. Apologies, it does get quite technical at times, so I'm doing my best. And one of the other aspects that members are asked to approve is effectively a minimum revenue provision statement of how we intend to set these monies aside. And you'll notice from the report we've kept the same statement in effect since 2008. Recognition, I think, the fact it's a stable position that we're not looking to change significantly. Ultimately, a minimum revenue provision is taking as much amount of revenue as is necessary across the asset life, the expected life of a particular asset we take out of revenue. There are options available for councils. They can voluntarily make greater revenue provisions if they choose to do so. To draw an analogy, it'd be like trying to pay off your mortgage quicker than might otherwise be the case. If we were in a position where we had talked again about how those reports informed by each other, if we were presenting members on a medium-term financial strategy, a position of significant surpluses over the next few years, with plenty of money around, we might be recommending that you increase them in revenue provision in due course. As members will be familiar, we're not in that position. On the converse, if we were able to and wanted to suggest a minimum revenue provision of anything less than the asset lives of the assets, I think we'd have the risk further down the line that we wouldn't, going back to Councillor Evans' position, that we wouldn't be in position to repay debts as when they came due. Hence, we feel the minimum revenue provision as set out, making a contribution for revenue according to the life of the assets we funded, is the appropriate one to choose. The other key aspects of the Treasury strategy we asked members to approve relate to the underlying borrowing strategy and the underlying investment strategy that the authority undertakes. In borrowing terms, we also asked you to approve something called the authorised limit. To some extent, this is a theoretical limit related to the capital financing strategy. If the internal resources were to disappear or there be any shocks, it gives officers of the authority the permission to borrow up to the 46 million. But it's by no means a target or a requirement. As members will note, our actual expectation over the next 5 years is at worst would only be possibly if the capital programme is achieved and gathers pace effectively, that 2.5 million 25-26 would be the only additional borrowing we're expecting to undertake. But it gives the headroom. That's just the purpose of the authorised limit. The headroom, if there were any significant external shocks, and internal resources were to dry up, officers do have the headroom to safely borrow up to that limit in the short term. We also notice within the borrowing strategy, it determines if we were to need to borrow, we've got a lesser limit of 15 million for borrowing at variable rates. Again, people with mortgages will be familiar that if you borrow, you've got a greater risk exposure to any borrowing at variable rates than you have at fixed rates. So if we did have need to significantly increase the borrowing, we would do so, or we would make certain we didn't extend beyond 15 million at variable rate. And we'll note the borrowing we've undertaken so far, the 15 million has been at fixed rates and thankfully a very low rate as well. And the final aspect of Treasury strategy is around our investing approach. So we have got the spare resources, which on a day-to-day basis, as council tax monies come in, various grants come in, our existing reserves, and we do have the ability to invest monies. Again, we follow best practice in doing so. And in terms of the balance between security of the council's monies, the liquidity of the council's monies, and potential yield, we make certain we invest within those priorities. So the first priority is always the safety and security of council funds. After that, we look to make sure the funds are not just belonging to us, but available at short notice if we need it. And only then as a third element do we seek to obtain the best return on our resources that we possibly can. That said, interest rates, as has been well documented, have moved very favourably with us in recent years to assist our MTFS, again, bringing out how the different strategies link together. Another aspect of Treasury strategy is how we report on a quarterly basis to this committee our performance against the measures you set us, both in terms of making sure no rules are breached and in terms of our performance against them. And the Q3 performance is the next report I'll present in due course. But I'll pause briefly, if it's okay, Chairman, to take any questions members may have on the Treasury strategy.
Yes, I hope I've got these reports in the right order. It's a question on Appendix E of the Treasury Management Strategy. It's on page 73 of the packs. Or if anyone's toggling on CMIS, on the circles to the bottom left, it comes up as 75. In that table, it's got prospects for interest rate, and it's got it talks about average earnings, which I've taken to be average earnings as in the money that people earn through employment. We've got down here, it says the expectation is that with the fall to interest rates and inflation, average earnings will fall to 3%. In our medium-term financial strategy, our expected pay increases were 2%. So I was just wondering, do we see that as a risk to medium financial strategy, or elsewhere we talk about retention of staff and that aspect as well? Thank you.
It's a great question, Council. I'll do this. It's a great question. It's just ever such a slight disconnect in that what Link talk about in average earnings is across the economy as a whole. Our medium-term financial strategy looks more parochially at what we expect the wage settlement to be for individual employees in local government. And as those of us employed in local government know all too well, we often lag behind the economy as a whole in terms of the settlements we've received. What they've included, though, is that what they're very conscious of is, from the Bank of England's perspective, what's happening to the economy as a whole is what does impact pretty much directly upon their thinking when they decide should interest rates go up or down. And you'll see that from the minutes of the MPC in recent months when they've decided whether to keep interest rates the same or bring them down or bring them up. So there's a tenuous link, but it is just that. But then going back to I think the more important substance of your question about do we think there's any risk to our MTFS? I think no. I'm quite confident in that in terms of how we've constructed the budget. We take a great deal of advice around what we think the pay awards are likely to be for our staff going forward. We've also got some earmark reserves set aside if we're wrong and the pay awards come in greater than expected. And I say you almost go down a ratchet of compensating factors in the back of our mind. I think if it was to be significantly wrong, if inflation was to be at a rate of 5-6% and we've only budgeted to say 2-3 years down the line, I think we'd be compensated through other means in terms of the actual local government finance settlement. They wouldn't, I don't think central government would see wage inflation in local governments go one way without compensating us another way. So the medium-term financial strategy has been built upon the best understanding we have around likely increases in our own staff rates. We've got some things in the back pocket if we're proven a little bit wrong. I suspect there'd be other, so it wouldn't just affect us if we're proved drastically wrong, it affects a whole raft of authorities at the same time. I think there'd be other assistance provided if the economy was to shock to the point of proof drastically wrong. And I'm hoping that answers your question.
Very thorough explanation. Do we have any other questions? Carry on. Right, the Audit and Risk Committee is requested to recommend for adoption by the council each of the 5 key elements of this report. Yeah, which you all have in front of you. Are we all happy to recommend this for adoption? That's unanimous. In which case we're back to John for Treasury Management update.
Thank you, Chairman. And as did some members, this follows on almost directly from the previous report. So that this is the third quarter report of how we've performed against the strategy that was set out by this committee and in due course endorsed by full council last year. And it is a very positive picture to present, as interest rates have moved very positive for ourselves in relation to the investments we've made. But the other important aspect of this report is it routinely confirms that where limits have been set, we haven't breached them. So the reports that the previous year's finance strategy, just to give some examples, on page 85 of your pack, where we set for our investments, there are limits that are applied and periods of investment applied. The table at the bottom shows how our current investments we've got outstanding are all within the constraints that are set by councillors. The table above shows the £15 million that we have in fact borrowed with the PWB, with monies as at the 1st September for the Q2 report and 31st December, the amount 15 million remains outstanding. But the table above shows the periods we took those loans out for and the very preferable interest rates at the time of 1.6 to 1.51% that we took the borrowing 15 million out at. On page 86, again, we talked about how the borrowing we took out is fixed rather than variable. Again, that shows how we make sure we're not breaching the variable limits. It's fixed rate borrowing that's undertaken. And the other thing I'll just take members to is the very first summary at the top, that the fact we are able to invest monies at the moment, and we are able to do so at interest rates are now creeping over 5% for the short-term investment trial to make. We earned 366k alone during the third quarter of the financial year. Going back to how our strategies overlap and informed by each other, the benefit of our treasury management activities in recent years, you will see as a very significant line in the MTFS when, as we already have done, when it's presented to over in your scrutiny, and will when it's endorsed, hopefully, by full council next week. Something you will be aware of, I wouldn't expect that quite to be achieved again in the fourth quarter. One of the natures of local government cash management is that council taxpayers are aware you pay your council tax through from April to January. So the actual receipts of council tax monies do tend to dry up inevitably during February, March. We will then have a little bit less money in the bank, and in the fourth quarter we tend to make a little bit less money than in previous months. And a final comment that I've been told I can make, one of the other checks and balances upon ourselves is our internal audit colleagues also like to have a look at our treasury management activities, and they go into the detail, making sure we're keeping all documentation, applying the treasury strategy as set out. And Deb and Sue's staff members just completed the audit on treasury management, and whilst there are some helpful recommendations, the overall underlying report is a substantial audit finding. So again, pleased to report that to committee members. I'll take any questions, Councillor.
Thank you, John. Recommendation here is quite simple. We note the report. Oh, sorry. Have a question?
Sorry, thanks, Mr. Chairman. Yes, just a quick question. It's on page 83 of the pack. Or if anybody's using the toddle on CMIS, it comes up as 85. I think it's on the money market funds. We've made a bit in the Federated Investors LLP. It's gone up from 5,800,000, yes, to 7,000,001. What have we put in there? Thank you.
There, well, I talked about earlier how we like to marry up security, liquidity, and return. The two at the top, Federated Investors and CCLA, are one of the best ways in which you manage the liquidity aspect. So they're short-term investments. So they're effectively a middle person in investing terms. We invest money with those organisations, as do a lot of other organisations, and they reinvest, but we can withdraw money from them very quickly as well. So the change from the two periods, 5.8 was just the totality of money we had out invested with them as at 30 September. As at 31st December, it's a bit larger still. And we are getting about 5.2% out of the Federated CCLA at the moment. So particularly beneficial to us. But if like they're middle organisations, we're unlike the internal the investments below, Lloyds Bank, National Bank Kuwait, where we're investing for a defined length of time, and that 5 million is less liquid. If we ask that money back tomorrow, we couldn't get it, but we're getting good interest rates. The ones above help the liquidity side. If we felt we needed money back tomorrow out of 18.1 million, we could get it. And I'll very briefly embarrassed, I won't ask to speak, but Lucy in the room does the work for me, looking at the monies we're getting in and out on a daily basis and telling me we've got an opportunity to invest some money because we've just had a grant in or council tax in and it'll be in those sources, or vice versa. We've got a creditor run coming up or the payroll runs coming out and we need to withdraw some money from those sources. So it's all about the day-to-day management of the cash resources and going back to that balance between security, liquidity and yield. Those two are focused, I think, more so on the liquidity side than anything else. And again, I'm hoping that answers your question.
Just a note, the report. Everybody happy with that? Back to John again for accounting policies, critical accounting judgments, and key sources of estimation uncertainty. I'll explain.
Thank you, Councillor. On to the last lap. So another report that comes to this committee on an annual basis, and a very important report. A report, I think, that destroys some myths about accountancy being a science rather than an art. But there's plenty of judgments we are required to make in the course of bringing a statement of accounts to members when the financial year is concluded. But having said that, it's an art with plenty of rules that apply to it. One thing members are pleased to know is we're not allowed to look at the numbers first and then decide which rules we're going to apply to make the numbers look how we want them to do so. We have to set out in advance what are the accounting policies, accounting standards, and when we're making critical judgments, how the methodology by which we're applying them to come up with a statement of accounts. And whilst this comes to this committee every year, there's just a couple of very subtle changes I'll perhaps draw members' attention to. One of which I think helps to, in real simple terms, outline how we go about the process of closing the accounts. And right at the start, on page 97 of your packs, in the very final paragraph, we've made a subtle change around how we're going to deal with any late invoices coming into the council. And apologies if this is making it too simple, but in basic terms, if an invoice comes in April that relates to service or goods that were provided, delivered before March 31st, normally the correct accounting is to accrue for it as a creditor. You account for monies in the previous financial year. And different authorities, mainly due to their size, will deal with this differently. So for very large councils, the county top tier councils, so forth, where they've got sometimes 1,000 invoices coming in, and for whom a small invoice of £200-300 wouldn't make that much difference, they will make provision in these type statements to say, unless they are over a given amount, we will happily ignore them. And their auditors are happy with doing that on the basis of materiality. You can ignore the small ones, it won't make that much difference to the overall outcome. We're a smaller authority, we've got less monies coming in, less invoices coming in relative terms. So those small invoices to us make a slightly bigger difference, but there's still a balance for us to draw, whereby our feeling was that after a period of time, and we've put the 19th of April down there, if we get any surprising invoices that come in and weren't expecting afterwards, we feel that if they're not over a certain value, the delay it causes to us in preparing our statement of accounts to bring them to yourselves in a timely fashion mean it's not worth our while making those adjustments, with the caveat, and that's the £10,000 coming in, if we feel that late invoice is actually, well, we really should include this, it would make a difference to how the accounts been, then we'll make an exception for those large invoices. So we try to achieve a balance between the two. We want to include all the invoices we possibly can in the correct year, if at all possible. Every invoice that we receive up to the 19th of April, we will accrue in the correct year. After that date, we'll make a judgment as to whether it is going to make a difference. And if it's a smaller amount, we think the bigger priority is getting a timely, accurate set of accounts to yourselves in time. So that's the first difference in this year to bring to members' attention, just as by way of an example. The second thing to bring to your attention is a change in accounting rules effect. It's going to take effect by compulsion, effectively from the 1st of April this year. The technical term being it is sometimes here referred to as IFRS 16, and it relates to how leases are accounted for. From that date, authorities will be required to show any leases they have and the assets they can effectively have use of on the balance sheet. And whilst we don't have, and say, take account from 1st of April this year means it will be reflected in the statement of accounts for the end of that year, so the end of 24-25. But we are required, as of now even, to allude to it. So when we present to this committee the statement of accounts for year ended 23-24, whilst we will not have incorporated IFRS 16, how we'd account for leases at that point, there will be within those statement of accounts a separate disclosure which will answer the obvious question, well, what difference would it have made had we adopted that accounting policy at that point? So there'll be a separate table within those accounts effectively showing this is the difference it would have made to our balance sheet had we included it in the year we're just coming to a conclusion on. And therefore members will be able to form their own judgment. So there's no surprises the following year. You'll know either to expect a big change or not, as the case may be. But just to, again, reassure members, the majority of leases we're aware of South Staffordshire relate to our street scene fleet, and they're not that significant compared to the impacts that IFRS 16 will have at a number of authorities. So we are expecting to show a table that shows a slight difference to the balance sheet, but not one that we'd imagine would raise any eyebrows or cause any sharp intakes of breath. But again, another example of how this particular document is important to make members aware of how we're going about closing the accounts. For members who read through every word of the statement of accounts when it was submitted last year, you'll have seen this report, as approved by last year's Audit Risk Committee, is repeated in full effectively in the final statement of accounts. We've also shared it in draft with Martha in attendance this evening, so we know that at first glance our external auditors are happy with this. To some extent, it then becomes a tool they measure us against. Quite appropriately, if we say this is how we're going to go about it, then if they find things that we've done that are in breach of it, it becomes their sort of measuring tool as an integral part of the audit. So I'll give you another flavour about how auditors will go about an element of their task. Otherwise, apart from the two elements I've just mentioned, I don't think there's anything else in this report that's different to how we've gone about our process in previous years. But as always, Chair, I'm happy to take any questions members may have.
Does anybody have any questions? Councillor Perry.
Thanks, John. Just one question around invoices received after the 31st of March for the previous period and a judgment is made. Who makes that judgment as to how to treat that particular invoice?
Hopefully, document about to approve tells us what that judgment is. So if it's received before 19th of April, we will accrue for it as a creditor in the previous financial year, come what may. If it's received post that date and it's over £10,000, we will accrue for it as a creditor in the previous year, come what may. And I think if we knew it's coming, I think we'd accrue for it as well. So if it just hasn't arrived on the desk, but someone says, I know it's out there, I think we're going to accrue for those as well, as my judgment. So the only exception is going to be a surprise invoice that hits our desks in that 4th week after the end of the financial year, that because it's below that 10,000 level, we decide it's going to be more costly in terms of us producing a timely set of accounts than worthwhile to include it. And again, hope that answers the question.
Case recommendation is that members review and approve the critical judgments that have been used in applying the accounting policies, the assumptions about the future and other major sources of estimation uncertainty detailed at Appendix 1. With that, that brings us to meeting. Thank you very much indeed. Attending.